Does an LLC have to make money to be considered legitimate? The short answer is no, but there are important tax implications to understand. An LLC, or limited liability company, is a business structure that provides owners with personal liability protection similar to a corporation, but with fewer formalities. This means owners are not personally liable for the company's debts or legal obligations, protecting their personal assets from business creditors. You do not need to generate income to maintain your LLC's legal status. Any small business can operate as an LLC as long as it follows state formation rules. However, tax obligations still exist regardless of profitability. Even without income, your LLC may need to file tax returns. Single-member LLCs treated as disregarded entities might not need to file if there's no activity. However, multi-member LLCs must file Form 1065, the partnership income return, even with zero income. LLCs electing corporate taxation must file Form 1120-S for S corporations or Form 1120 for C corporations, regardless of income. Filing returns when required helps maintain compliance, avoid penalties, and establishes your business as legitimate in the eyes of the IRS rather than being classified as a hobby. By default, LLCs are pass-through entities for tax purposes. This means the business itself doesn't pay income taxes. Instead, profits and losses pass through to the owner's personal tax returns. Single-member LLCs report business income on Schedule C of their personal return, while multi-member LLCs file as partnerships. LLCs can also elect to be taxed as corporations by filing Form 8832 with the IRS. C corporations pay a flat 21% tax rate on profits, which may be lower than individual rates ranging from 32 to 37%. However, this creates double taxation where profits are taxed at both the corporate level and again when distributed to owners. One significant advantage for LLCs taxed as pass-through entities is the qualified business income deduction. This allows eligible businesses to deduct up to 20% of their net income, substantially reducing taxable income. Business expenses are deductible for LLCs with income, reducing overall tax liability. Common deductible expenses include startup costs, business travel, marketing and promotion, inventory costs, office supplies, legal fees, and home office expenses. Without income, however, claiming substantial deductions may trigger IRS scrutiny. To optimize your LLC's tax situation, consider several strategies. Leverage all legitimate deductions to reduce taxable income. If your LLC generates significant profit, electing S corporation status can help reduce self-employment taxes. Contributing to retirement plans like SEP IRAs or solo 401ks lowers taxable income while building retirement savings. LLC owners typically need to pay estimated taxes throughout the year if net income exceeds $1,000. A good practice is setting aside 25 to 30% of net income for federal and state taxes. Payments are due quarterly on April 15th, June 15th, September 15th, and January 15th of the following year. To summarize, an LLC does not need to earn income to maintain its legal status, but tax filing requirements still apply based on your tax classification. Understanding deductible expenses and tax strategies can help minimize your tax burden. Proper planning, including setting aside funds for estimated taxes and leveraging available deductions, will help your LLC remain compliant while optimizing tax liabilities. For complex tax matters or LLC formation, consulting with experienced business attorneys or tax professionals is always advisable to ensure your business structure aligns with your financial goals.